Alright, what up, Internet? It's your favorite financial realist, here to spill some uncomfortable truths. You're probably scrolling through endless TikToks of some dude in a rented Lambo, flexing about how he crushed it on AMC or whatever meme stock is trending this week. Or maybe you're watching some guru with perfect teeth promising you 10x returns if you just buy his course. Let's be real for a sec, that's not investing. That's glorified gambling with a side of cope. Today, we're tearing down the stock-picking hype and putting the spotlight on the unsung hero of generational wealth, the quiet, consistently boring, and undeniably superior strategy of index funds. Buckle up, Buttercup, because your perception of wealth building is about to get a serious upgrade. This isn't about getting rich quick, it's about actually getting rich, slowly and surely, while those stock pickers are busy chasing vaporware. So, why do so many of us fall for the siren song of stock picking? It's simple, really. Humans are wired for stories, for heroes, for dramatic wins. We hear about the college kid who turned $500 into $50,000 on some obscure biotech stock, or the Reddit army that squeezed hedge funds. It's intoxicating, right? The idea that you could be the next Warren Buffett, just by reading a few charts and doing your own research, which usually means skimming Reddit threads. Social media doesn't help. Every other finfluencer is hyping up their latest play, showing off paper gains, and conveniently forgetting to mention the devastating losses. They tap into our deepest psychological biases, overconfidence, the illusion of control, and FOMO, fear of missing out. We see a stock shooting up and think, I could have been in that. And then we try to be, usually right before it crashes. But here's the cold, hard truth. For every one person who gets lucky picking individual stocks, there are hundreds, if not thousands, who lose money, underperform the market, or simply waste countless hours stressing over their portfolio. The data doesn't lie. Year after year, study after study, the vast majority of active fund managers, these are the professionals with teams of analysts, billions of dollars, and Ivy League degrees, fail to beat a simple, unmanaged index like the S&P 500. If the pros can't do it consistently, what makes you think you can, scrolling TikTok in your PJs? Add in transaction costs, emotional decision-making, and the sheer time commitment, and stock picking quickly becomes a negative-sum game for most retail investors. It's like bringing a spoon to a knife fight and expecting to win because you believe in your spoon. Now, let's talk about the antidote to all that financial anxiety, index funds. Yeah, I know, index funds. Sounds about as exciting as watching paint dry, right? Good. Because, boring, is where the actual wealth is built. What even are index funds? Simply put, an index fund is a type of mutual fund or exchange-traded fund, ETF, that holds a diversified basket of stocks, or bonds, designed to track a specific market index. Think of the S&P 500. It's an index of 500 of the largest U.S. companies. An S&P 500 index fund doesn't try to pick winners, it just buys a little piece of all 500 of those companies, in proportion to their size in the index. This genius, passive approach means two critical things. 1. Instant diversification asterisk. Instead of putting all your eggs in one volatile Tesla basket, you're spreading your investment across hundreds or even thousands of companies. If one company tanks, it's a blip, not a disaster for your portfolio. This seriously reduces risk. 2. Low cost asterisk. Because no one is actively researching stocks, making trades, or trying to time the market, the management fees, called expense ratios, are incredibly low. We're talking fractions of a percent, like 0.03% to 0.15% annually. Compare that to actively managed funds charging 1%, 1.5%, or even 2% per year. Those tiny differences add up to millions over a lifetime. The entire premise is brilliantly simple: instead of trying to beat the market, you become the market. And historically, the market has always gone up over the long term, despite all the bumps and crashes along the way. Since its inception in 1928, the S&P 500 has averaged an annual return of about 10 to 12%. That's a reliable, compounding engine for wealth that most stock pickers can only dream of consistently matching, let alone beating. It's the ultimate, set it and forget it, wealth machine, allowing you to focus on living your life, not glued to stock tickers. Let's get into the nitty-gritty, because the numbers here are truly mind-blowing. Compounding is your best friend. Imagine you start investing $500 a month into a diversified S&P 500 index fund, averaging a modest 8% annual return. After 10 years, you've contributed $60,000, and your account is worth approximately $91,500. After 20 years, you've contributed $120,000, and your account is worth approximately $292,000. After 30 years, you've contributed $180,000, and your account has ballooned to over $745,000. Now, compare that to someone trying to beat the market by stock picking. They might have a few good years, but then one bad pick, one market downturn they couldn't time, and they're set back significantly. The beauty of an index fund is that you consistently capture the overall growth of the economy, without needing to be a Nostradamus of the stock market. Fees, the silent killer. This is where things get really spicy. Let's revisit those expense ratios. Suppose you're in an actively managed fund that charges 1% per year, versus an index fund that charges 0.05%. Seems tiny, right? Wrong. Over 30 years, on that $745,000 portfolio, that 0.95% difference, 1% to 0.05%, could cost you hundreds of thousands of dollars. Let's do the math. If your $745,000 portfolio were subject to a 1% annual fee, that's $7,450 per year going to the fund manager, not to your retirement. Over decades, compounded, these fees erode your wealth like termites. With an index fund, your fees would be around $372 a year on that same portfolio. That difference isn't just pocket change, it's the difference between a comfortable retirement and having to work longer. You're literally paying someone else to probably underperform. Make it make sense. Taxes, the other sneaky wealth killer. Stock picking often involves frequent trading. Every time you sell a stock for a profit that you've held for less than a year, you're hit with short-term capital gains taxes, which are taxed at your ordinary income tax rate, often much higher than long-term capital gains rates. Index funds, especially broad market ones, have very low turnover. This means they buy and hold, minimizing taxable events. You mostly pay taxes when you sell your investment many years down the line, and then at the lower long-term capital gains rate. This might seem small on a year-to-year basis, but over 30 years, the tax drag from active trading can be immense. You're effectively losing chunks of your money to the taxman and your broker, instead of letting it compound for you. Okay, but I can pick winners. No, statistically, you probably can't. And even if you get lucky once or twice, can you do it consistently for 10, 20, 30 years? History suggests almost no one can. And what happens when you pick a loser? Your winners have to work twice as hard just to get you back to zero. It's an emotional roller coaster with a high probability of ending up below market average. Index funds are too slow. I want to get rich now. Here's a dose of reality: wealth building is a marathon, not a sprint. If you're looking for get rich now, you're looking for gambling, not investing. Index funds build wealth steadily, reliably, and without the constant stress and fear of ruin. If you chase the latest pump and dump, you might see quick gains, but you're far more likely to see even quicker losses. True financial freedom comes from patience and discipline, not chasing hype. But where's the excitement? Dude, if you want excitement, go skydiving. Go to a concert. Play video games. Investing should be boring. Seriously. The more boring your investing strategy, the more exciting your life can be, because you're not constantly worrying about your portfolio or checking stock prices. Your money is working hard for you in the background, quietly compounding, while you're out there actually living. What about market crashes? Yeah, markets crash. They always have, and they always will. But guess what? They also always recover, and then some. An index fund diversifies you across the entire market, so you're not solely dependent on one company's survival. During downturns, you continue to invest with dollar-cost averaging, buying more shares at lower prices. When the market inevitably recovers, you're positioned for massive gains. Stock pickers often panic sell or get wiped out. Index fund investors simply ride the wave, knowing the tide always comes back in. It's about resilience, not reactivity. Alright, so you're ready to ditch the hype and embrace the boring path to actual wealth? Good. Here's how to actually do it. 1. Open an investment account. If you don't have one, start with a Roth IRA or traditional IRA, for retirement, or a taxable brokerage account, for non-retirement goals. Major players like Fidelity, Vanguard, and Schwab are your friends here: low fees, robust platforms, good customer service. 2. Choose your index funds/ETFs. You don't need a million options. For most people, a simple 3-fund portfolio, or even just one total market fund, is all you need. Total Stock Market Index Fund, e.g., VTSAX/VT or FSKAX/ITOT. This buys a tiny piece of virtually every publicly traded U.S. company. Maximum diversification within the U.S. Total International Stock Market Index Fund, e.g., VTAX/VXUS or FSILK/IXUS diversifies you globally, so you're not just reliant on the U.S. economy. Total Bond Market Index Fund, e.g., VBTLX/BND or FXNAX/AGG provides stability and income, especially as you get closer to retirement. Or, even simpler, a Single Target Date Fund, TDF, from a reputable provider like Vanguard or Fidelity. These are pre-made portfolios of index funds that automatically adjust their stock-to-bond ratio as you approach your target retirement year. It's literally investing on autopilot. 3. Automate your contributions. This is probably the most crucial step. Set up an automatic transfer from your checking account to your investment account every payday, $50, $100, $500, whatever you can afford. Consistency is key. You won't miss the money if it never hits your checking account, and your future self will thank you. 4. Set it and mostly forget it. Seriously. Once you've set up your funds and automated your contributions, step away from the daily market news. Resist the urge to tinker. Check in quarterly or annually, sure, but don't obsess. Your job is done. The market does the rest. 5. Rebalance occasionally, optional, but smart. Every year or so, you might want to check if your asset allocation, e.g., 80% stocks, 20% bonds, has drifted due to market movements. If stocks have had a great run, they might be 85% of your portfolio. Sell a little bit of the overperforming asset and buy some of the underperforming one to get back to your target allocation. It's essentially, buy low, sell high, on autopilot. So, there you have it. The quiet wealth strategy. No limbos, no viral TikTok dances, no complicated charts, and definitely no gurus promising you overnight riches. Just consistent, disciplined investing in the broad market, leveraging the power of compounding, low fees, and tax efficiency. While everyone else is out there chasing the next meme stock high, burning themselves out and losing money, you'll be quietly, confidently, and reliably building real generational wealth. It's not sexy, it's not glamorous, but it works. And isn't that what we're actually here for? To build a future where you don't have to stress about money? Stop simping for stock-picking hype. Start investing smart. Your future self will thank you. Now go touch some grass, your portfolio is fine.